being a traditional short seller, again, you were never out there trying to make absolute returns except in down years. But again, for guys like us, we're more activist short sellers. We're like investigative journalists digging into companies to expose dark secrets. And rather than selling subscriptions and ads, we take risk and trade alongside these investigative reports. So it's different from what most traditional short sellers did.
All right, guys, bang, bang. I've got Carson here with me. Carson, I thought a great place for us to start this conversation is this idea of a reappearance of short selling. But there's kind of two different stories from my external view. We have on one side, folks like yourself or Hindenburg Research who have these great track records of shorting stocks, coming out and kind of exposing a lot of whether they're actual frauds or kind of mismanagement and just bad behavior in the market, and kind of a check on the people who are just ultra bulls, ultra long all the time. On the other side, we see short selling coming up a lot when it comes to these meme stocks and these short squeezes that are occurring. It appears that usually the people who are shorting there are kind of more traditional hedge funds that don't necessarily specialize just in shorting. Can you give us a little bit of your understanding or kind of like your view as to, on one side, it seems like short selling is working and people are making money and they're calling out the bad companies. On the other side, it seems like people are getting blown up left and right. And, people on Reddit are having a field day. And so which one is it?
Right. Well, it can be both. And I think what a lot of people don't understand about what we do as activist short sellers, so short selling itself is a niche, and activist short selling is a niche within a niche. And the issue is, so vast majority of the shortable universe consists of companies that are just basically melting ice cubes. So if you're going to short it, you think it's melting faster than whoever's on the other side of this thinks it's melting. And that's fine, but for activist short sellers, that's not what we do. We're not going out, at least good activist short seller isn't going out and screaming like, I think the competition is going to erode margins faster than the street does. My model beats that. No. The crux of what we do is we're looking for situations in which generally management has manipulated the information that it's giving to investors. And that's usually so that management can pump the stock and dump it. Sometimes it's because they're able to get the companies to engage in transactions with companies they have interests in. But in any event, it's when management is misleading, egregiously misleading or outright lying or concealing, lies of omission, concealing material information. So that's where activist short sellers come into play. And we're not usually looking forward to say, we think this is what's going to happen. We're looking backward. The company told you this was misleading because blah, 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 and they didn't tell you that. And so, up to you, investor, you extrapolate the future based on a past that you've just been shown was a lot less positive than you thought it was. So that's what activist short sellers do. And, it really, in the post-GFC environment, it just seems like every public company CEO, it feels like it's his God-given right to monetize at least like $50 million worth of stock. And the environment has been so corroded because pretty much, so many of these companies are really pushing, they're close to the line in a lot of respects. And I guess what's different is the long side, at least, until maybe 22, and arguably still the case though, the long side began cheering this on because it became clear in the post-GFC world that on the long side, you were no longer being remunerated for caring about risk, right? So the guys who cared about risk got derided as value investors and sort of laughed into a corner. And, the dudes who were like, yeah, give me some narrative, give me some blue pill, I'm going to crush that shit up and, blow some rails. Those were the people who were, rewarded financially. So that's why there's still this target-rich environment for activist short sellers, is because the behavior has just become so pervasive and so egregious on the part of company managements. Now, when you look at the bigger picture and these, how you've got more and more funds saying, okay, we're not going to do single name shorts anymore. So that there's somewhat different dynamics there. So most long short funds, historically, the dirty secret is they didn't really care about shorting. It's just a way to get a higher fee structure, right? Like they were trying to make their money on the long side and, charge a 2 and 20 instead of just being paid, like 100 bips on, on assets under management. So they were sort of reluctantly shorting. Now, those are the pretend shorters as well as the real ones. They're usually looking for the melting ice cube type of shorts. And, that's fine. But really, that was never a strategy that was designed to make money. It was not an absolute return strategy. It's like, we're looking to generate alpha. So, we're going to be, we're like 150 gross and we're net long 50. And, we're just trying to create alpha with our shorts. And every now and then you have a year in which the market goes down, and that's when those shorts are actually going to provide some absolute return. But by and large, you're doing it to smooth volatility. So that generally worked, except the problem is allocators got really tired of losing money, on the short side because, at least until, late 21, 22, the market was just going up. That's it. So you had that dynamic, and then something else that also I think a lot of short sellers, have been in the game a long time. Because look, the reality is you haven't had a lot of people since the financial crisis come out of the woodwork to say, I want to be a traditional short seller. So these are mostly people who were, whose careers started well before the GFC. What they don't understand is when they look at their book and they say, well, I'm short, 50 different names or 30 different names. So there's diversification there. They're short the same factors in many cases. So, and this is a more sophisticated way of looking at market movements and understanding them, is looking at what factors are actually responsible for the movement. So it's no longer just saying, beta drives markets. It's factors, style factors like momentum, or you could have, tech, et cetera. So when you're short, when you're concentrated in these factors in your short book, and something moves against you, especially the guys who are shorting kind of the scammy little companies or the ones that are out ahead of themselves, they're short the momentum factor. And so when momentum starts, popping, they took real losses. So that's part of the reason that even prior to the meme stock phenomenon, a lot of funds that were running short books decided that they were going to do short indices instead of shorting single names or short ETFs. With the meme stock thing, it's just one more thing that, it's another bitter pill, I guess, for short sellers, because it's like, hey, you've got all of these retail investors who individually are pretty small, but they band together in order to pursue completely non-economic behavior. Like, what are you going to do about that? Like, if they're going to say, yeah, I'm proudly going long, AMC, or Tupperware. What do you do if they want to be non-economic? So it's, it's being a traditional short seller. Again, you were never out there trying to make absolute returns except in down years. But it's only been worse and harder. But again, for guys like us, we're more active as short sellers. We're like investigative journalists digging into companies to expose dark secrets. And rather than selling subscriptions and ads, we take risk and trade alongside these investigative reports. So it's different from what most traditional short sellers did.
Talk to me a little bit about like the anatomy of one of these deals, right? So how do you guys come up with the ideas? Is it somebody giving you a tip? Are you guys doing a kind of on the ground research? Do you have kind of a bucket of names and you're like, okay, let's see if we can go find, kind of a thread to start pulling? Like maybe like where do the ideas come from? And then in each one is probably a little different, but like what is the process at which you then say, okay, we've got a kernel of information that we believe this could be a potential fraud or misleading or whatever. How do you get and build the conviction to eventually go put a short on where if you're wrong and you put a report out, you're drawing attention to the name, it could go against you, right? And people say, no, actually we disagree, and then you lose money. So like, how do you build that conviction and where do these ideas come from?
Sure. Well, I'll take the second idea first because it'll help inform then where the ideas come from. So the when you look at our process, I'd say there are basically two stages to it. So if you were say a tiger cub, which they generally do, they will short the fraudy type companies, the stock promotions. That's been a tiger specialty. So by the time they get conviction internally and they have the meeting and say, yeah, this sounds like this is a problematic company, let's put some risk on, let's short it. So we probably take more or less the same amount of time to get to that level where we say this is a problematic company, and that call it 2 or 3 weeks. But the issue for us is we're going to go public, and I've referred to this as market-based prosecution. Like we're trying to build a case against the company and often the individual managers of the company in the public, and we're not trying to talk to other short sellers and say, you should short this. Like, actually, we don't want that. We don't want other guys shorting it and crowding it because it does make it more squeezy. We're talking to the longs. So what is going to be, so we need to present an overwhelming case that's going to make longs say, wow, I didn't know this. I've been misled. I gotta reevaluate this position here. And it's hard because a lot of people on the long side, they get really defensive, and they take it almost as a personal affront, like you're challenging their intelligence. And like you can be a really, really sharp investor and you can still get scammed. And I've been defrauded hard, even in the past 13 years that I've been doing this. Like I was the victim of a major, massive fraud carried out right under my nose. So it's not that, so unfortunately, when longs take these things as insults to their intelligence, they shouldn't. I mean, but in any event, that's the type of resistance that we're going to meet. And everybody wants us to be wrong. Everybody on the long side wants us to be wrong. And the companies are going to come back with everything they have. They're spending other people's money to try to oftentimes throw like a tidal wave of public relations at us to try to, to basically, try to push the stock back up and get out of trouble. So that will take months for us. I mean, we've taken, in some cases over a year to build the case. And it depends on exactly what the thesis is, but a lot of times it involves field work. So we've done some stuff recently, late last year, and we've talked a little bit about it this year as well. We were short a European company, German and UK real estate, and we were short the bonds. So this isn't something that U.S. investors know, but they've been taking valuation gains on their assets. Basically they say, oh, it used to be worth 30 million euro. Now it's worth 40 million euro, and they're borrowing against this inflated base. So we send investigators out like, well, this building is completely shut down. It's covered with graffiti. It's got broken windows. Looks like a real piece of shit. Like, how are you going to say that it's suddenly worth like 10 million more euro and worth 40 million euro, which, we know it's X square meters roughly on a per square meter basis is way too high. So that's the type of thing we'll do. We also pull filings from around the world. And this is one of the things that's interesting. The US we consider to be a very transparent jurisdiction, but it's not when it comes to corporate filings. But I mean, Europe, Asia, like pretty much all around the world, we can get interesting information, including subsidiary financials. And, we'll look at those things. And sometimes the subsidiary financials don't add up to what's been reported in the SEC consolidated financials. So that's something else we do. We'll talk to industry experts, and we want to make sure that we understand the way the business should look. We speak to a lot of former employees. And when we have these conversations, we don't do so as muddy waters. So we usually do those through these, expert or consulting networks. So we're paying, like $1,200 an hour for a call or something like that. And, it's important to us that we position ourselves as potential long investors in the stock, because we don't want somebody to go in and think like, oh, if they'll be happy if I give them the negative stuff. We're trying to get them to think we want the positive, and if negative things start to come out, then we drill into it. But those are really the tools of the trade, plus a significant amount of accounting analysis on the actual consolidated financials and the disclosures. Now, where do the ideas come from? As you noted, there are far fewer funds that are shorting single names. So we did used to get pitched ideas all the time. The way that funds, once upon a time, if they were short something that was kind of scammy, they would go to the traditional media to pitch a story, like Enron. Well, the media is generally not in the business. Traditional media is generally not in the business of reporting bad things, of doing investigative reporting into companies, because the economics of that are just not there. It just takes way too much in the way of resources. A lot of people don't want to read long form journalism, and they just don't need the threats and the actual litigation. So they would come to us. Now, again, that has dried up somewhat because a lot of funds stopped doing single name shorting, but for us, I mean, we're looking a lot of times, and it sounds almost flippant to say this, but we're looking for the stuff that seems too good to be true. So if there's a lot of money flowing into a particular industry, the scammers are going to come out of the woodwork. And so it's not necessarily the first company in the space that goes public, not necessarily the second, but by the time you're on the third or fourth company going public in a given space to try to capitalize on the money grab, there's probably something to do there. Companies that have significant assets or operations in emerging or frontier markets, always, worth looking at. Companies with complex accounting. So it's, and then a lot of times it's just following people around, like certain, key shareholders or stock promoters or investment banks or even lawyers, following them around and seeing what they're involved in. And, because these guys, once you're in scam stock world, you generally don't get hired into legitimate company world. So, every few years they'll pop up in a new place, and, we look for those guys.
What is the ESG grift? I know it's something that you've talked a lot about, and it's one of these industries where a lot of money has flowed. We now are starting to see analysis of like ESGs all over someone's website. The portfolio may not reflect the ESG, kind of talking that they're doing. We're now even seeing some people say, well, hold on a second, some of the actions we're taking that are ESG friendly may actually be hurting certain countries or companies. Like, what is kind of your take on that whole world right now?
Well, there's a lot to unpack there. And, but I mean, at a high level, one of the issue is there are a lot of subsidies at stake. And so the companies that have become really big are the ones that are best at hoovering up the subsidies. And they're not doing it by coloring within the lines. So for example, if you look at Sunrun, and this is, I think largely true of the other major residential solar companies, there are these investment tax credits that you get if you put a solar system on your roof. And the vast majority of Sunrun customers don't actually buy the systems outright from Sunrun. If they did, they would pay roughly $3 a watt for the system. But what they do instead is they enter into power purchase agreements with Sunrun. So Sunrun installs at its own cost, it installs the system on the roof, and basically you agree that you're going to buy power from it for 20 to 25 years. And so Sunrun then takes these power purchase agreements, and sometimes they're leases, but it's a similar concept. They then take these power purchase agreements and they stick them in an entity, and they, and basically each one of these power purchase agreements entitles somebody to have an investment tax credit. So Sunrun and the other solar companies lose money hand over fist. I mean, even their EBITDA is massively negative, which really takes a special type of business to do that consistently. But these are just cash incineration machines. But so Sunrun's unable to use these investment tax credits itself, but it effectively sold them by sticking these PPAs into an entity and kind of selling off an interest that receives the tax credit. Now, the issue here, the grift, is that if you go back to what my statement that if you bought this from Sunrun and said, yeah, hey, I'm going to pay cash, put it on my roof, you'd pay about $3 a watt. By the time Sunrun finishes all of these machinations and valuation games for the PPAs, because that's what it then gets the investment tax credit on, is the agreement, not the system. They go and they claim credits that are based on about $5 a watt. It's like, whoa, wait, how? Wait, like if the arm's length value is $3 a watt, how is it that just because you put a bunch of paper on it, you flip it into a different entity, it's $5 a watt? And we've gone into this in detail, but but I think the clearest, most abusive tactic that they use to juice the valuation is when they say, well, what's this power purchase agreement worth? They actually include the value of the anticipated tax credit in that. So they're like, oh, well, we're getting a tax credit of this, so that automatically like boosts the valuation of this by 20, 25%. And then of course now there's a little bit more of a tax credit, so we boost it again. And so it's this iterative process. But it's just ludicrous. Now, that's the problem when you have a setup, and I understand why the government has certain they've got policies that they think are good for society. Let's subsidize the private market, to do this. But problem is you're always going to have people who are abusive and push, and really push the line there, or maybe are over the line. Those are the ones who are going to be the winners, the ones who are just able to vacuum up the money the best. So that's one way in which ESG is a grift, just tremendous abuse. And that's not just in the residential solar space. It's in a lot of this green stuff. Wherever there are subsidies, the winners generally are abusing the system. Then of course we have the whole greenwashing thing, calling something sustainable and green when it's not. And then as you alluded to, there are a lot of questions about like, well, gee, is a solar panel really as green? I mean, a lot of times when they talk about, the carbon savings, they're excluding where it's made. China, what type of power is used to produce it? Coal-fired power. How does it get over here? Diesel-powered boat. And then what happens when the sun doesn't shine? Well, you generally have to have a backup generator online. So when you look at the utility scale solar projects and wind projects, they have to have a power plant that's idling, because you can't just say, okay, well, we're going to flip the switch and spin it up. So it's idling and emitting carbon all the time. So when you get the accounting for the carbon emissions, a lot of times it excludes that stuff. And I'll just like to give you an example, one of, I think, the most egregious examples of this type of bullshit accounting that I've come across. Within the EU, countries like Germany had shut down a number of their coal. Well, they were going to shut down their coal-fired power plants, but the way the EU's carbon accounting system works is if you stop burning coal, but you replace it with biomass or wood that is sourced from outside of the country, then you can use that in your coal-fired power plant. I guess there's not a lot of capex needed to change it over, and it won't count against the country's carbon emissions. But the reality is, if you're burning wood to get a unit of energy, you are releasing far more CO2 into the atmosphere than you would with coal alone. So they're basically saying, oh, look, we're reducing, our carbon emissions, we're on target to meet the EU's goal, but they're just burning a bunch of fucking trees to do that. So that's part of how the system is gamed, and part of why it's really, just top to bottom and, right to left. I think like ESG is largely a grift. And, bottom line is the one energy source that we always should have focused on was nuclear, but the Greens hated that. And so, yeah, you want something that's cheap, renewable, and, and basically limitless. Yeah, nuclear.
The funniest part to me is when you see the ESG company rankings come out and the oil companies are above like Tesla, right? And again, like without even getting into all the details, you're like, all right, something's going on here we probably should look at. Another area where I think a lot of people have questions, and I know you've got a lot of expertise because a good part of your early career was actually on companies based in China. And you had immense success in terms of finding these businesses, kind of calling them out, shorting them, and not only profiting, but also I think kind of cleaning up a lot of that market. What is kind of your view of US-China relations and even Chinese companies, both based in China and then trying to cross-list into the US? It seems like there's like a geopolitical conversation and, are we in competition? Are we working together? Maybe both, kind of what's going on there. And then these companies when you start looking at some of the legal structurings of the cross listings, the companies that are in China, it seems like there's still frauds that continue to pop up there. Like, just kind of talk a little bit about US and China and kind of how you're viewing those two markets right now.
Wow. Yeah, no, there's really a lot to unpack there too. Oh boy. Well, maybe the place to start is you characterized our earlier work as having helped clean up the space, and that was true for a moment in time. But what happened? So I started doing this by accident, really. I was out of the markets. I was living in China. I had a business there, and my father, who was a microcap investor, professional investor, he got really interested in these Chinese stocks that had listed in the US via reverse merger. They're all growing so quickly, so profitable, and what a gift to American investors that they chose the US to list. So I had no notion that there was widespread fraud here, but he asked me to look at one company initially. It was a company called Orient Paper, and he told me some things about it that just seemed like red flags, but I didn't really want to look at this company because I had my own, just every day was like a grind, with my business there, and was kicking my ass. But ultimately this was my father, so I took a look at it. And just before going up there to take a look at the factory, that's when I finally read the filings, and it was filled with obvious lies. I mean, these filings, just like prices, the valuations of land, of equipment. I mean, just shit that, because I'd been in China and doing business there long enough, I guess I was seeing the matrix, and I knew that these things were lies. So wrote a report exposing that, having no idea that this was systemic, and, immediately was contacted by a lot of people who said, like, these are hedge funds who'd been shorting these things. Look at this one, look at that one. And just opening the 10Ks and like, oh my God, obvious fraud. So very soon realized that it was systemic. Now, why was this systemic? To some extent, the entire finance industry, there are just massive conflicts of interest, and people can point fingers in other directions. But that's really acute when it comes to China. But ultimately, from the first wave of fraud, so we then sprinted. So this was June of 2010. We published this first report, and I'd say that this wave ended in late 2013. Most of the Chinese companies' valuations in the US, at least the reverse merger ones, were in the toilet by then. And the zeitgeist was China is uninvestable, and nobody wanted to look at Chinese companies. And so what had happened was, during that whole wave of fraud, and that's chronicled in the movie The China Hustle that you talked about, only one company chairman ever has done material jail time in the US. And that's because he was actually a citizen of Taiwan, not of the PRC. Otherwise, China drew a moat around these guys. And then Chinese policy banks like China Development Bank began financing take privates of some of these obvious complete frauds. And so investors in the US were actually, or investors in quotes, if you were long these things, some of them got paid huge premia as these things were taken out. And so what China knew about us that we evidently don't know about ourselves is that it's really easy to wipe our memory. So again, as China's cleaning up some of these total frauds, and most of them had just basically gone to well below $1 and traded on the pink sheets, if traded at all, by taking out a few of them, 2014 comes around. Alibaba's going to go public. Everybody wanted Alibaba. Man, that was hot. It was sexy, this and that. So all of a sudden, we're off to the races. And so then you got this next wave of Chinese IPOs, and these were generally online companies. And they were real businesses in most cases, like the RTOs, the reverse merger Chinese companies, and from the first wave, they weren't real businesses. Most of them were just basically empty boxes with like a facade of a factory. But these were more real, and they're online, so it's harder to prove. Now, we would look at the filings for a number of these things, and we would see that the tax treatments were fucked up. And that's pretty common with these frauds, because when you're making things up, one lie basically leads to, you need like 100 lies to cover up one lie. So you'd often see the strains in the tax treatment. But going public and saying to investors who, were just so desperate for more growth narrative, especially, since the US was recovering slowly from the GFC, saying like, hey, we think it's a fraud because this tax and these taxes don't make sense. Nah, people want the photos. They want the overwhelming proof. And I mean, at the end of the day, they didn't want us to be right. And by that point in time, we were also up against this kind of institutional barrier, which is all of these guys who basically pegged their careers to being long China stuff. Well, I mean, if you're now saying this, these larger, more established, companies are also frauds, what are they going to do with their careers? Like this is, like they'll die on this hill. And so there was so much institutional resistance in those instances. And then China also overtly turned hostile to people like us. And that actually happened in the summer of 2012 when they sent out Ministry of State Security personnel to basically every investigative firm in China. And, who are your foreign clients? What are they looking at? Are any of them hedge funds? Are they short sellers? And basically chilled that industry. And they put a lot of the government filings on lockdown as well. So today, almost impossible to get these filings, but that's part of China's generally closing itself off. But everybody had forgotten about this and didn't care in the US until Luckin Coffee came along. Now, we didn't do the work on Luckin. Somebody else did. We publicized it. We went into their data room and validated it. And I know who did the work, so that also spoke to me a little bit more. But yeah, the fraud there was just so bad that the auditor actually had no choice but to find it when doing the audit, right after we had publicized this third party's work. And so it's just funny talking to reporters after Luckin imploded when, they're saying, wow, this is incredible. Like, bro, this has been the game forever. And understand this. And I think this is the big point that people really should take away from the situation is if nobody gets punished, which again, nobody except for one guy who was Taiwanese has done prison time in the US, and I'm sure none of them have done prison time in China for defrauding US investors. It's heads I win, tails I don't lose. If this thing works out, I make, I used to say tens of millions. Now it's hundreds of millions, maybe even north of $1 billion. If it doesn't work out, whatever. What have I lost from doing this? So that's the thing. And so people then after Luckin, what happened then was the SEC really started looking at it again, but the SEC hated and hates China cases because just the amount of time it takes to get stuff from China, then you have to get it translated, incredibly resource intensive. And even once it's translated, you don't understand the legal context. If you're an SEC enforcement attorney, you have to bring in people who are experts to explain it. It's super resource intensive and you almost never get anything out of it because they're able to sit in China and give the finger to the US regulators. And then China codified that into law in 2021, where any company must, with people or assets in China, must get express approval from the China Securities Regulatory Commission before cooperating with an overseas regulator. So China puts that in law that basically you can't even respond to the SEC, even if you're listed there. So, there's no way of protecting US investors. And, I'm glad to see that the cynicism toward China has returned, but that was only after countless hard lessons have been learned by investors. And you know what? The moment China's GDP really, not the bullshit GDP number they give you, but like in reality, the moment China does start turning things around economically, everybody's going to want to forget these lessons and rush in with a bunch of cash and claim to have edge. And, I know, I have Guanxi over there. And, the cycle will repeat because in the US, we just can't help ourselves.
We're capitalists at the end of the day. Another area where a ton of capital continues to flow is artificial intelligence. It seems like in the private markets specifically, that is basically holding or propping up the venture capital kind of funding environment. Is just put AI on the name on the end of a name, and money will show up at your door. What about in the public markets? Are you guys seeing the same type of thing where there's tons of money pouring into legitimate businesses, or the illegitimate? What are you seeing in AI?
Well, you're definitely seeing like a lot of companies do the global find and replace, taking out servers and putting AI or software AI. So yeah, everybody's suddenly an AI play. Maybe one of the just most laughable ones, and we're short this name. We haven't published on it, but this company called Applied Digital. Those guys seem like a bunch of jokers and some very questionable dealings with the investment bank B. Riley. But yeah, I think we haven't seen a bunch of companies going public yet that are AI plays that are total scams. That's coming, right? But we've got kind of we've got a bit of a weak market that's I think been holding up the IPOs. But if this were a few years ago, before the SEC really put a chill on the SPAC market, the SPAC AI SPACs would just be like the golden age of being an activist short seller all over again, or that plus the China reverse mergers. But yeah, it's coming. Guys like us will be all over it. And at the end of the day, though, we do need more of these companies out there, because what happens when there's so much money flooding into a space, if there are really only a few places for it to go, like Nvidia, good luck. Like, I'm not that Nvidia is a scam, but even if it were, like, good luck trying to break that, because it's the focal point, the relatively few focal points for the money flooding into AI. But once you start increasing the denominator here, the money gets sprinkled around, then it's a lot easier, to come out and break the stock price when you can present compelling information about why the investors have been misled.
How do you think about short sellers making money? One of the things, and not your firm, but there was an article about Hindenburg, right? And obviously they've been writing a bunch of short reports and stuff. But somebody broke down the math of what they possibly could have made in some of these shorts. And what was fascinating to me about it was less about, how much money they are making or not making, because it wasn't, fully confirmed. It was all kind of loose guesstimates, if you will. But it was more of, we're now having a conversation about it where people are realizing this could be a viable investment strategy. It could actually make money. People have been talking about longs like that forever, right? And kind of the ability to go long and make money. And we can see you bought the stock at X price and you got it at Y price, whatever. I was actually pretty surprised to see folks trying to back into the math of like, hey, how much are the people actually making on the short side? Without sharing specific numbers or kind of whatever you're comfortable with, like, has the opportunity widened in terms of, the economic kind of capital you can gain here? Or has it actually shrunk as there's less short sellers or less public companies? Like, what are some of the dynamics that maybe feed into the ability for short sellers to make money doing this?
Well, okay, so it's for one thing, there are a lot of activist short sellers out there. You just haven't heard of most of them. So on Seeking Alpha on any given day, there are a bunch of guys screaming at the top of their lungs, this is the worst thing ever, like writing about some 90 million market cap piece of shit. And, like the world doesn't notice them. In the US, we're used to this sort of public criticism. So guys like that don't move the needle. And a lot of them will try this for a little while and then just, flame out because they're not getting traction. And what a lot of people forget about Hindenburg is that, Hindenburg and his principal, Nate Anderson, when he was grinding it out for years as an activist short seller, didn't really have much of a brand. And, and this was reported, I think, in the New York Times, but, he was at one point worried about getting evicted because he was having problems making his rent payments. And then they broke through on Nikola and just, blew up overnight, right? The Hindenburg brand, and they do great work, and now they're noticed. But that's the thing, it's a very tough space, at least with US companies, to break into. It's a lot easier in Europe because Europe is much more a culture of, not criticizing people and companies publicly. And P.S., you don't have the speech protections outside of the U.S. that you do in the U.S. So that's another dynamic. Now, even when you look at guys like me, like Nate, whatever, we make good money. I mean, by most people's standards in the world, like we make pretty nice money. But in finance, if you think about it in finance industry terms, first of all, the amount of brain damage per dollar that we earn is way off the scale, way off the charts relative to, just being like the close your eyes and buy kind of, business model. Because of all the litigation, I've now been through, fucking 3 investigations, France, Germany, even the US, which the US wasn't supposed to happen, and millions of dollars of legal fees and just bullshit, time sucks, et cetera, on top of the companies that sue us and shit like that. The death threats, et cetera. So, even if you're like, oh, that's good money, I think I can make what Carson Block makes. A lot of people, when they start doing it, they're just like, fuck. There are easier ways, if you're bright and you're talented, there are easier ways in this industry of making that kind of money. Absolutely. Why do I do it? I mean, it's what I want to do. Like, so that's the thing. And it's cliche, but it's cliche for a reason. It comes back to this. You really have to enjoy what you do. You have to find meaning and purpose in it. Because if you're like, yeah, I'm going to do this for the money, you're going to be gone in, within months, probably, because you're just going to find out there's so much bullshit here and it's so hard. So yeah, I mean, there are a lot of guys who, like I said, a new one is probably born every day to go on Seeking Alpha and scream about something. But the people who are relevant, who have staying power, there aren't that many of us. And, and there's some of whom I have very high opinions of. Others of whom I think suck and they cut corners and they're doing shit they shouldn't be doing. So it's like every other industry. You've got people who operate at a high level and do the right things, and then you've got people not so much.
Yeah, it's interesting you describe it this way in terms of like the brain damage per dollar. One of the things I've been fascinated with, and I've talked with a number of investors who, most people would know their names and are highly respected, as to why has there not been a new, young, long activist investor, right? If you go back to the days of the Carl Icahns, and all these people who like now are kind of seen as legends of Wall Street, or people who have been doing this a long time and really kind of took the activist approach and went in and fixed these businesses and suggested things, made a lot of money doing it. It doesn't seem like there's really been anyone who's kind of said, hey, I'm going to go do that. And one of the thought processes has been, it's a hard life, right? Like, yes, there's social media, there's all these things that you get. But just because you're long the stock, same as being short the stock, like you're still telling someone they're doing a bad job, right? Mm-hmm. And so I wonder how much of that plays into, people just not wanting to be as public as maybe they were back in the day before social media, before there was so much interest on this activist, type of investing in either direction. The biggest fortunes aren't made on Wall Street. They used to be made there, but now they're being made in private markets. Consider Mike Walsh. He put $5,000 into Uber. He's just a regular dude, turned into over $24 million. Such opportunities were once held behind closed doors, reserved for those who had connections or vast fortunes. But not anymore. Start Engine is now going to tear down that glass ceiling and make startup investments possible for you and me. The company is led by Howard Marks, the co-founder of gaming giant Activision. And they got 1.7 million users that have put in over $1.2 billion of transactions on the platform. But the best part is the platform's not even backed by traditional venture capitalists. It's backed basically by the community. They've raised over $75 million in crowdsourced funding to date. Go check them out at startengine.com. You can open up a Start Engine account today and you can explore live investing opportunities with starting investing amounts as little as $100. Startengine.com. Go check them out today.
Well, I'm speaking a little bit out of school now because it's not what I do, but I mean, we have looked at long-side activism as a business model in the past. And so here are my impressions. Similar to short activism, it's very hard to break through. I think there are a lot of managers out there trying to do long side activism, but number one, until you raise, for most of them, unless and until you raise a meaningful amount of AUM and can really accumulate significant shares of the voting stock, you're irrelevant. So how do you raise a bunch of AUM? Well, you do it with a track record of activism. Okay, but so you have this chicken or egg problem, number one. Number two, with all those years of free money, a lot of the low-hanging fruit was plucked long ago in terms of, easy strategic fixes, governance fixes, business fixes. And so what you ended up getting into was, I think a lot of long-side activism did become this form of, like extractive capitalism, basically, where it's like, you don't have enough debt on the balance sheet. I want to run the business conservatively for a rainy day. Nah, shut up. If you oppose this idea of levering up your balance sheet, selling your real estate and leasing it back, et cetera, then, we'll go to a proxy contest. So what a lot of it ended up becoming in the US was financial engineering, which, I'm no fan of that. I mean, a lot of what we look for are companies that are overly financially engineered. The accounting is legal, but it's very misleading and it's covering up a lot of rot within the business. But it's this type of extreme, highly aggressive financial engineering by long-side activists that can create the conditions for muddy waters to later come in. So, but yeah, I mean, why should I, as an allocator, give $1 to this guy who's trying to break through and, be a financial engineer when, there are these other better established players over there. But the final thing is, and this is, I think maybe, if you talk to the established players, this is probably the answer they would give you is that, look, we're very effective, but we don't have to go public to do it. The goal is not to go public and have a war. The goal is to be constructive behind the scenes, work with the board, work with management, and basically generate, create value that way. So yeah, I think a lot of the most successful activists, I think they define themselves, maybe that's a little bit too strong a statement, but I think a lot of the most successful activists are actually looking for, non-campaign campaigns, just quiet behind the scenes, situations. So yes, it doesn't generate the headlines, but that's where a lot of the action is.
Yeah, that makes sense. One of the last questions I have for you is you all manage a fund. So it's not only just your capital, it's also outside capital. You've had this impressive track record. I've seen in filings where you guys have talked about, I don't know if it's 8, 9, 10 different delistings after you guys have kind of published on companies. And so what is like the LP or the institutional kind of appetite for this type of stuff, right? And what I mean by that is I think it's twofold. It's like, one, there's an investment strategy, right, of kind of activist short selling. But then there's also this idea of like, if I allocate to muddy waters, I also am then dealing with like, is Carson going to get a death threat today, right? Is like, is there going to be a lawsuit? Like there's all these other components to it. And so like, how have you seen maybe that change over time as well? Especially when, you first started out, you were based in China, you were going after Chinese companies. It was kind of like you were really doing research and stuff like that, to like now you're a full-blown asset manager who's got a track record. And I think most people would agree are one of, if not the best short sellers over the last, 15, 20 years. How does the institutional world kind of respond to this? Or what does that environment look like today?
So yeah. I mean, look, our LP base is, it's generally speaking smaller institutions and ultra high net worth individuals. And the reality is with activist short selling, people might look at the numbers and say, whoa, great numbers or whatever, but it's not scalable. Really, it's not, you could not manage $1 billion in AUM in an activist short selling strategy. Like it just, no.
Why not?
I mean, because most of us, I mean, us anyway, we're generally going to be out there 5 or maybe 6 times a year on a company. And the trade capacities, the companies that are generally better situated for activist short selling are the ones that don't have as much sell side coverage. So they're mid caps. And actually very few short activists can swing a bat in the mid cap space. Most are in the micro cap and small cap space because that's where you get the most egregious behaviors. So we have the resources to really deconstruct complex mid cap type situations. But, at the end of the day, these are not large caps, so we can only have so much money in the trade. Like the trades only have so much capacity. And if we're doing this only 5 or 6 times a year, I mean, call it even 4 to 6, there's just not that much money that we can actually put to work productively. So that's the issue with short activism. People could look at the numbers and be like, wow, great numbers. But yeah, you can't scale it to be that big. And, and if you do, then the tail starts wagging the dog. You're looking for like large liquid companies as opposed to problematic companies. Let's look at this large liquid company and see if we can find some problems. So I think that, I think really trying to scale, much bigger than we are. I mean, we returned capital at one point, because we're just like, look, this is too much. We can't put this much to work. So that's the issue there. Now, I mean, in terms of LP base, so smaller institutions, I mean, we'll never be pretty enough in this space for sovereign wealth fund. I mean, our investors generally are like, look, we're not worried about headline risk. We don't have that big a name, so like nobody's going to give a fuck that like blah 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 backs muddy waters. Now we do have a few investors who do have some name brands based on the type of institution they are, but they believe in what we do. They understand that we're keeping markets honest. And they have to get comfortable with the idea that, at the end of the day, if it came out that you were invested with us, like it's not going to be the end of the world, right? Like people would forget it pretty quickly, and it's not even a story to begin with. So, so there's that. But yeah, we, there's a lot of, I got to tell you, we spend a lot of time, or I've spent a lot of time, insulting certain sovereign wealth funds and their governments. So like the Saudis. So I don't think we're ever going to get like PIF money, like some of the other, and we've made comments about Norges Bank as well, about how, I mean, they're great like SEC lenders. If you see Norges in something, I mean, they own all this dog shit around the world. But anyway, so yeah, that's it's a very niche type of LP who's interested in investing with us. And I guess the final thing is to that, like, for me, I'm not going to be what a lot of institutional investors would want me to be, right? You're not going to come into the office, meet with me, I'm not going to wear a suit. I'm not going to have that institutional looking office. I'm not going to refrain from, saying fuck this, fuck that. And like, those are the behaviors that you undertake if you really care about raising money. But, my attitude is like, look, I want you to understand what we're all about, because, if you have a problem, with this, then like, we're not a good match. Let's save each other time. And, and you're not going to, worry like, does he smoke weed? Because the answer is yes, not before meetings and stuff. But, like, you got to be comfortable with us personally and professionally, is my view. And so, yeah, we're not going to pretend to be, more polished than we are.
Yeah, that makes sense to me. My last question for you is, there's a bunch of companies that were really, really hot private companies. They went public, massive valuations. I'm thinking WeWork, I'm thinking BuzzFeed, all these different businesses. They now have drawn down significantly. Some even argue maybe they are mid caps at this point, right? And kind of like, I'm not saying that they're doing anything wrong. I don't even know if anyone has come out and publicly said that they've done fraud or anything like that. But just like, now the size is significantly lower than they were. What do you think happens to those types of companies? Like, is that like a things in motion stay in motion, and they're likely to just keep going down over time and eventually get delisted? Do you think that there's like a theme in some of these really hot private companies from years ago? Hey, the market's just down and like it'll come back and those companies will benefit. How do you kind of think of maybe like this cohort of, I'll call it like tech enabled businesses that got tons of private funding, went public, and the public markets essentially have rejected those valuations and reset them at something much lower?
It's an interesting question, because the short answer is I don't know, but it's interesting because I used to joke some years ago that 700 million is the new zero, right? Like nothing ever went to zero, and now I think you could even say like the new zero is like north of $1 billion. I think there's a lot psychologically that happens here where investors will look just reflexively look like, well, peak market cap was like, 22 billion. So at like 1.3, there's got to be some value there, which is a totally non-scientific, ass-backward way of valuing a company. But I think that that's effectively what goes on. So, what ends that? So I don't know. I mean, you look at WeWork, it's funny because, I mean, that business model has always been a bad business model. It's just a rent arbitrage. And like, yeah, it was cool. You like cool offices, right? You spent a lot more on your, on your CapEx, on your FF&O than like Regus did. But Regus has been bankrupt at least once, I think maybe twice. It's always been a shit business model. So, but do people, will it always hold some allure, or for a long time hold some allure? Because it used to be like SoftBank valued it at like what, almost 50 billion. I mean, people still think SoftBank is smart money. Like people still care what Masa thinks. I mean, it's the biggest joke on the planet. So, okay, maybe not the biggest, but in Masa and SoftBank have certainly been, the butt of many jokes internally, even before, like all this stuff hit the skids, where we are. But yeah, I don't know. But I think that inherently that WeWork business model, a rent arb, is just such a difficult business model. Maybe you could run it profitably at a relatively small scale, but that's probably a better private business than a public business.
Yeah, that makes sense. And it I think just speaks to kind of like the way you think about the business, right? It's like at the end of the day, you could put all the bells and whistles on it. It's a rent arbitrage business. And is that a good business or not? And one of the aspects that I think I've really paid attention to is the public narratives on plenty of business, both public and private. It isn't the same as maybe, kind of a direct, just boil it down to what is it? And I do wonder how much of that is in the mainstream media, certain journalists, they just don't, they're ill prepared to combat the professional communications teams. Like I think a lot about, like if you are a journalist at one of these mainstream outlets, and I have plenty of friends that are there that are amazing, and I have plenty of friends there that I'm like, hey, you probably should go find a different, role, right? And they probably know that. But the ones who are not skilled, who are not trained, who have not been doing it for a long time, they get run over by the communications teams. Right. And then vice versa. The ones who are really good, they're calling bullshit left and right. It's like, like the referee who just throws the yellow flag every single play on the football field. Right. They're like, that's not true. That's not true. Whatever. And so, you described earlier short sellers, like there's really good ones and there's ones who aren't so great. I think you see that in companies, you see that in the journalism side. And so really it's when you're reading this stuff, trying to figure out who are the really high quality journalists that when you read it, that they're just not rewriting the press release. They actually have done work and you can kind of put more, I think, weight on it. And so, how many articles got written about WeWork as a rent arbitrage business? Not that many, right? I mean, there's a movie. Exactly. They don't really talk about that much.
Yeah. Well, it's funny. I know one of the venture, I know principal at one of the WeWork's venture backers. And this is before this is, maybe a couple of years ago. I sat down with him and it's just funny. We had these really different takes on Adam Neumann. And I got into it first. I was like, as soon as I read this article in the FT about how he was having these retreats and, and he's preaching veganism and, but he actually apparently really eats meat. Like I knew this guy's a fucking like a total scammer. Like that's a glimpse of how he really thinks about the world. I assume, you really are, would never, put money with a guy like that again. He's like, no, you're wrong. Like he was probably the best salesman I'd ever met. And, I'm like, but yeah, that's a problem, right? Like that's a guy I want to short, a good salesman. He's like, no, that's a guy I want to go long in venture because he's going to be able to, convince more people to put in more money at higher valuations and eventually convince somebody to, bring them public and subscribe to the IPO. And, so in the venture world, they want the salesman. The short sellers, we want the salesman. We're just different parts of the life cycle, I guess, is the irony.
You should go look at that venture capitalist portfolio. Maybe there's good short ideas in there for when they're public.
Well, and he's actually one of the guys who's like more of a like purist and zealot. And like, it's something I puzzle over with, a couple of years ago, we had some interns, and I brought them to New York, and I sat down with a guy who's CEO of a reasonable sized investment bank, and he he made a point, or he told a story, and then he said to the interns, I said, reputation is everything, and you can't sacrifice your reputation. You got to be honest and above board, and this and that, and I'm like nodding and like, yes, that's exactly correct. But then he told this story, which is a great story, and I'll try to nutshell it. But he got into the business in investment banking in the 80s. He went to a school that banks didn't recruit from. So he sent in applications. He was getting rejected everywhere. So he took his first Boston rejection letter, and it was signed by somebody in HR. So he called up the First Boston switchboard in New York, and he said, yeah, give me I want to talk to a vice president, not understanding that like everybody at a bank is a VP. And, the switchboard operator said, which one? And he's like, well, just start reading from the directory alphabetically. So, Jim Adams. Yeah, I'll talk to Jim Adams. Jim Adams picks up the phone. He says, hi, my name's so-and-so. And he looks at that letter, the woman who signed it, the HR, person who signed it, and says, yeah, Sharon Michaels told me I should call you to set up an interview. Oh, okay, yeah. So he totally like finagles this interview, goes in. The guy's like, man, you're great. Let me introduce you to, my director. And the director's like, man, great interview. Let me introduce you to an MD. And so by the end of the day, an MD calls down to the person in HR and it's like, yeah, we're giving this guy an offer. She's like, well, we can't. We rejected him. And they're like, no, you're hiring him. So he got hired. Like, what a great story. Like the chutzpah. Like, it's awesome. But we just finished saying, don't bullshit people. Be honest. Your reputation's everything. And so the lesson here is that there's an acceptable, if not optimal level of bullshit in this world. And that the world, especially in finance, runs on some level of bullshit. And so it's an interesting philosophical question to ponder, when have you crossed the line? Like when is your level of bullshit too much? And I think if we look at Elon Musk, it's like a great case study. I mean, this guy lies a lot, but he also delivers on stuff too. Like he built the car, the rocket flies, etc. So, like net, where, and on the short side, I will admit, a lot of people have Elon Musk derangement syndrome. But he does lie a lot. So it's an interesting dynamic.
Yeah, this is fascinating to me because how do you get at, if you were talking to the founder, right? Let's say you're talking to Elon and you said to Elon, hey, why did you say X? And I don't know, let's say it was delivering the vehicle on a certain timeline. It's like one of the critiques, right? It's he'll say a timeline and then the car's not delivered. And he would say, at the moment when he says it, he's like, because we're going to do it. Like he full on believes it. He's not, bullshitting and trying to lie or manipulate the stock price or whatever. So let's just hold constant for a second. The assumption that like he fully believes that is the timeline. And because he chooses a timeline that is ridiculously short and aggressive, he doesn't hit it. What I've always wondered is like, on one regard, like we need a guy like that to be able to make the car and fly the rocket and like do all that kind of stuff. On the same side, right? Like when you evaluate what he's saying, you're like, this is bullshit. There's no way he's going to deliver a brand new car in 2 months. Right. And like even the engineers probably working on it are like, dude, 2 months. Like if I sleep at the factory, maybe 3, right? But like 2 months is like impossible. I guess it like kind of gets into this weird world of like, if he believes it and he's just being overly optimistic and he eventually does deliver the car, but it's like a timeline thing versus take like an Enron where it's like just an accounting fraud and it's just like, hey, these people were lying, right? How does the market view that? Because I think Elon's this fascinating example of like, there are people who literally will yell and scream all day long about how Elon is the greatest thing since Jesus. And then there's other people who are like, this guy lies all the time and is full of shit. And like, by the way, I'm complaining on Twitter, right? Where like he's, so like, I don't know. How do you like balance it? And maybe there isn't a right answer, but I think he is maybe like the epitome of this, kind of conundrum, if you will.
Yeah, no, I mean, he definitely is the epitome of the, of that tension. We all believe in honesty, but, and the reality is, I shouldn't say the reality is, my assumption is, I think he understands a lot of times that he's lying. And it's not just, making pronouncements about the future that are too optimistic, but even talking about things that are or are not. But I think he understands this, but the short case was always predicated on, hey, you're going to get crushed by the majors, right? You don't have a large enough sales base, so your unit costs are going to be too high, and everybody was looking at the manufacturing base. But what Elon, I think, was focused on, and what only he understood, and like everybody on the short side, it just took too long to many, I think, do not understand this, is that what mattered was the capital base. So by getting Tesla's market value so high, right? Even if, they're not going to run out of cash because they can keep issuing stock all the way. I mean, there's so much, I'm not sure where the cap is right now, but as of a couple of years ago, when I had this thought, it was about double that of Toyota Motors, right? So I think he got that, hey, in order to compete with these guys, in order to have staying power, I need to have massive market cap. And I think he said, I'm going to do whatever it takes to have that massive market cap. So, maybe it's a bit, of an armchair quarterback to say, well, yeah, but you really didn't have to be that egregious in a number of these bullshit pronouncements. Maybe he didn't, but and do I think that he should still be held accountable despite the fact that, and like people on the short side hate when I say this, but he did move the needle. He pushed the world toward electrification of vehicles much faster than it would have gone without the majors. Now, again, we can dive into this and explain why, well, if you're filling up your car with coal-fired power, you're probably better off with a 6-cylinder internal combustion engine. But putting that to the side, the future of humanity at some point does need to be based on electrification, which I would argue for nuclear powered electrification. But yeah, he's, but I think that's what the game was. He knew he needed the market cap because otherwise he couldn't do it. But unfortunately, I feel like he can't turn off that. He was rewarded, as he pushed the needle. I think he's changed a lot personality-wise over the years. I mean, I don't know him well. Like I met him one time back in 13, but I feel like he's changed a lot personality-wise over the years because if you cross the line and you get a positive reward, it's very Pavlovian, I think, this process. So I don't know that he's what I would consider to be a good person anymore, good at heart, but look, he's done some things that need to be done. And I guess where I most admire him is actually in the space realm because I knew somebody who used to be very senior at NASA on the technology side, and I mean he told me things like the average age of a NASA engineer at that time was in the upper 50s, and they still program in Fortran because these are government jobs, and it's clear the future of space for America has to be private sector. So. And and Boeing sucks, overruns, and and Elon's he's got it done in that area. So hat tip to him.
Carson, I think that's a great place for us to end. Where can we send people to find you on the internet or find out more about Muddy Waters?
Well, I mean, I'm not that active on Twitter or X, which is something Elon has fucked up, but that's at Muddy Waters Re, and we publish our research at muddywatersresearch.com. Unfortunately, we don't check the info box as often as we should, but there's also, yeah. So, but anyway, that's the best way to do it.
Awesome. Well, I appreciate you taking the time to do this. We'll definitely do it again in the future.
All right. Thanks, man. Enjoyed it.